Where do you get your advice when you're looking at property investing? If you're like most people, it's the media and social media. I guess when it comes to property investment, the noise from the financial media can be deafening. But how much of what you see and hear and read is really worth your attention? That's what I discussed today with Brett Warren, National Director of Metropole, as we explain some of the myths and some of the mistakes that people make because they're listening to the media. In fact, we're going to break down a whole lot of things that the media doesn't tell you about property investing rather than what they do tell you. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of all the mixed messages. That's exactly what this show's about today, because we're going to help you develop financial freedom through strategic property investment advice. And we talk about money management on this show as well. I'm looking forward to a fun chat with Brett Warren. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Brett. Welcome back.
Oh, Michael, good to be with you and good to be picking up on some of the points we discussed last week, following on from our discussion. It was good.
Well, last week we said we're going to share some of the things the financial media won't tell you about property. Look, when it comes to property's always in the media. The media knows that homeowners, first home buyers, established homeowners and investors love hearing about property. Every week there's the auction clearance results and talks about what's happening to houses and rents. What they tell us is statistics, and that's good. But there's a whole lot of things that, in my mind, they're not telling you properly about property. I guess many commonly held beliefs have come from social media and others telling little myths about what's going on. And in my mind, that's one of the reasons most investors, 50% apparently sell up in the first 5 years of owning a property. 92% of investors, according to the tax department, never get past their first or second property. And that's a shame. I think we've got to just remember that investors do have a role in Australia. I know the media loves talking about the ugly, greedy investors taking advantage of landlords. Brett, before we talk about the media and where it gets things wrong, maybe I'd like to also explain one of the things that gets wrong is the role of property investors in Australia, and occasionally, or actually more than occasionally, often painting them as ugly, greedy investors taking advantage of tenants and pushing out home buyers. But we know, because we see we've seen over the years we work together, thousands of investors. They're everyday people. There are teachers and nurses and policemen, and yes, there are wealthy professionals as well. But most of our clients don't fall into that category, but they're going to become wealthy. But their motivation really is to pursue financial independence, not to be dependent upon the government. They're looking to protect themselves, and they're also, in my mind, contributing to society in a number of ways, Brett.
Yeah, I'm pretty passionate about that, Michael. I mean, the majority of all of our clients I work with, and I know they're not selfish or greedy by any means. And as we talked about, 92% of investors only really own one or two properties. I think the other thing about the media is they tend to focus on those people who own 30 or 40 properties and, all those kinds of things. And I guess the minority that are, slumdog landlords and things like that as well. It's always media sensationalism. But hopefully today we can, unpack some of that.
Well, let's put a bit of perspective to this. In Australia, the government provides very, very little rental accommodation compared to in a lot of countries. Now, there's no doubt that the government should be providing social housing for the disenfranchised people. There will always be people in trouble. But in a lot of other countries, the government also provides housing for people who can't afford to own a home. In Australia, they're not even providing enough social housing. So about 2.9 million rental properties around Australia are provided by mum and dad investors. They provide accommodation for over 8.5 million people. That's about 1 in 3 Aussies who rent a property getting their home from property investors. Now, that's providing a service. And if you're running a business and providing a service, you deserve to get a reward for your risk. Some
You'd
would
think
actually
so, wouldn't you,
suggest
Michael? You think so?
you would, wouldn't you? Now, in my mind, that's actually saving the government. Look, who knows? I've read a figure of up to $2 trillion by not relying on the government to fund the supply of rental properties as they do in other countries. Now, property investors also pay a lot of tax back to the government. Now, the latest figures I could pull out were for the year 21-22, but it actually showed that property investors paid in the order of $4.5 billion in council rates. You and I know that we got to pay
Absolutely.
our rates. They've paid about $14 billion in land tax. And I'm not going to say the majority of that was in Victoria with our highest land tax rates, but we're putting money back into the system. When property investors sell, yes, they do get a capital gains tax benefit. But according to the tax statistics of 21-22, property investors paid $20 billion into the public coffers of capital gains tax. By the way, if homeowners sold their home, and they did, they upgraded, they downsized, they didn't pay capital gains tax. But the media isn't saying, hey, it's not fair. Why don't you charge capital gains tax to homeowners? Oh, but the greedy investors, yeah, let's charge capital gains tax to them. And investors paid, Brett, in the order of $6 billion in stamp duty in that financial year as well. So property investors provide a service and, like all businesses, pay their fair share of tax. Now, I don't know how much tax they were paying, some negatively, yeah, yes, they do, and get some tax concessions. But over time, most investors end up having a level of cash flow positiveness. I mean, that's what they're doing it for. So let's just remember, we're providing accommodation for 1 in 3 Aussies. A lot of us are small business people, Brett.
We are, and we are providing a service, and we're not just providing a service for those tenants, but those people are complaining. We're obviously helping with the roads and the trains and the infrastructure and things like that as well. So, it's a very disappointing piece, I guess. And I often, speak about that with our clients at times as well. They kind of feel like they're being isolated, and for trying to do the right thing by their family and also for the community.
And the government at the moment is seeing them as an ATM that let's see where we can take as much money from them as we can. So sorry I got sidetracked, but like you,
No,
I'm
it's
a bit
worth pointing out.
passionate about that
Yeah.
because I believe that the media isn't balanced. So on the one hand, it's picking on property investors. Hey guys, stop picking on us. Number two, they actually don't tell us a number of things. One of the things is that they don't tell us that market's more than just moments. The media loves a good story, and in the realms of property, again, it talks about hot tips, alarming trends. They don't emphasize the cyclical nature of property. Markets move in cycles, and while the media focuses on the ups and the downs, successful property investing actually takes us back. Got to look at it from a high level view of a long-term investing strategy, a long-term perspective, because property investing is a long game, and patient investors who don't get caught up in all the white noise of the latest market moves up or down, in my mind, they're the ones that have the last laugh.
Yeah, they are. And look, let's expand this not just to the financial media, but also social media. And obviously, the market is more than just moments, but also property investing more than just moments as well. Because I know it's quite easy to look at the highlights reel on someone's Instagram and think
Yes,
they're
yes.
doing a great job. So there can be a bit of a mirage there. And I guess that's what today's about, right, Michael? It's most people tell people what they want to hear, but we may be getting to a few uncomfortable truths today by telling people what they actually need to hear to be in a better position.
Point. Yeah. Well, I think one of the things the social media is telling you is property investing simple. Oh, by the way, I've actually got the secret of how to do it really well. There's no secrets out there. I've written books. Other really clever people have written books. Our podcast is very popular, but there are other people who have very good podcasts. You've got to be careful who you listen to. But property investment is simple, but it's not easy. And in my mind, that's not a play on words. Just because something's simple to understand doesn't mean it's easy to do or make money from. In particular, we've already said most investors never get past their second property. And half of them sell up. But the latest statistics show that there's only 19,198 Australians who own an interest in 6 or more properties. That's less than 1% of all investors get to that point. Oh, by the way, we did a survey of the results of our clients at Metropole a couple of years ago and showed they're 7.3 times more likely than the average Australian investor to own 6 or more properties. I guess they made the right decisions because they got the right advice. But it is simple, I guess, if you follow a time-tested, proven strategy. But I think the problem is we're irrational. We're emotional when it comes to money. We know what we should do, but we don't do it because of our limiting beliefs. That's one of the things we discuss at Wealth Retreat, isn't it? That
Yes, it
we all
is.
drive around with one foot on the accelerator and one on the brake.
Yeah, definitely. Look, I also think, I mean, anyone can go and buy a house, and I guess that's part of the problem too, isn't it? You can just go and buy a house anywhere you like, and people do get emotional. They don't think they have to think too much about it, and they've heard something on the TV that they've resonated with, and they just go and do something. So I guess the disappointing thing for me, Michael, when I first started following you, was you told me that it would take 30 years to become financially free through property. I was
People
25,
don't
and
like to hear that, do they? They
I
don't
was
want it.
shattered. I was shattered. I was hoping to retire by 30. I was 25, and all of a sudden, I've got one of the most sought after commentators telling me it's going to take 30 years. Maybe tell us a little bit about that, Michael.
Well, it's still the same.
Mm.
Property cycles take a while, and it doesn't matter how many properties you buy. So I've read, and I have no reason to disbelieve these people on social media, that they accumulated 5 properties or 6 properties over a couple of years in regional Australia. But that doesn't make you financially free. It's not how many properties you have, but the value of the properties and how much money and how well they work from you. So I believe you've got to end up at the end with your own home with no debt against it, because when you eventually want to become financially free, you don't want non-tax deductible debt. You should have a residential real estate portfolio. And I think anyone who tells you property only, or shares only, be very wary of them and run away quickly, because I believe once you've accumulated an asset base, you've got to start churning out cash flow to replace your personal exertion or your professional income or your business income. So some of that will be property, some may be commercial property, and some may be shares or ETFs. Now, I'm not giving any financial advice, but the answer is it takes a long time to build a substantial asset base. Now, it depends what you want. I know there's people out there saying, I'll show you how to live on $100,000 a year. Yeah, but once you've paid tax, and with health costs going up and insurance going up and the cost of living not going up as much as it used to, is that really what you want? Do you want to live in your golden years with a lower income than you did in your working life? Do you not want to help your kids and your grandchildren and take them to Disneyland, or help pay for their school fees, or give them some help from the bank of mum and dad? So if you want a substantial passive residual income, you need to build a big asset base. And no matter what anyone tells you, the facts are that takes time, Brett.
Yeah, well, like, I guess once I got over my disappointment, Michael, we worked together, we talked further, and the good news was that I guess with the right strategy, we could speed that process up. We talked about adding value, we talked about buying in the right locations to achieve that financial freedom sooner. So those advisors and I guess mentors are really important. And we always use the analogy of a plane, don't we? Flying from Brisbane to Melbourne, 99% of the time it's off course. You need someone to bring it back on track and make sure we're heading in the right direction, and buy at the right time and renovate and develop at the right time. And having a mentor can really speed that process up. And that's really what's worked for me as well. Very, very well.
Having a mentor, you've got to have a plan. You've got to have the right plan. You've got to use a strategy that works and has worked over the long term rather than the short term. So that's why when we see new clients at Metropole, we always start putting a strategic plan together using some very powerful software to help them understand, are their plans realistic? Are they doable? And then if they are, what you have to do to get there, and what you should not do to make sure that you don't go off track, Brett. And so therefore, when people come and see one of our wealth strategists at Metropole, so let me give a shameless plug for the team that you look after, when they first see the wealth strategist, we don't even talk about property. Where do we start the conversation?
We start with where they are now and what they'd like to achieve over the next 10, 15, 20 years, and then kind of work backwards, understand their baseline. And once we get their baseline, there's 99% of the time a gap between where they are now and where they'd like to be. And then we'll put a number of different models and scenarios in place rather than just going out and jumping on the nearest property.
Sure. Now, there's lots of ways of getting there. And an example I know we both have used with clients over the years is you're in Brisbane, I'm in Melbourne. There's a number of ways of you getting to me. You could get on a plane and get there fast. You could drive. You could go along the coastal roads and enjoy the journey and stop off and have a holiday and then eventually get here. Or you could go down the highway and do it quickly and only stop over once overnight. And it's much the same of how our clients are going to get to their journey. Some want to stop off and have a baby or have a trip overseas. Others are in more of a hurry. Some are prepared to pay the extra fee to go on the toll roads to avoid the traps along the way. And so that's how we help them. And once we do the plan, we're much more than just a buyer's agent, I guess is what I'm trying to explain. We actually give strategic property and wealth advice, structuring advice. Then our buyer's agencies with teams on the ground will actually help you implement the strategy, and then annual reviews, and we look after our clients through property management. But we've also got ways of speeding things up, outperforming the averages, not just through property selection, but our property development team manage projects and help clients become what I like to call armchair developers, to be able to manufacture capital growth and rental growth. So sorry that I sidetracked us a bit, but I thought it's an opportunity to give a shameless plug for what we can do a bit. And that's how you can shorten 30 years, because it takes a couple of property cycles. You can't just do it in one cycle. And that's because residential real estate, in my mind, is a high growth, but a relatively low yield investment. But too many people buy a property because they want cash flow. They need cash flow, so they think, I'm going to get a property and it'll pay my school fees or it'll pay for holidays. Doesn't work that way, does it?
Bit of an uncomfortable truth, that one, isn't it, Michael? I mean, most people I speak to, I guess speculators and people who want to invest in property, the first thing they say is they want the cash flow. And to have someone, I guess, stand up and say, no, it's not going to give you the cash flow, don't expect the cash flow, is quite confronting. But I guess the good news is there's variables we can change there to minimise that cash flow. But I guess what we're saying is, don't bastardise it. Understand that residential real estate is a high growth asset. So let's make the most of that. It's going to be the compounding and leverage and growth that gets you into your next property, that grows your wealth faster. And I often hear you say to people, Michael, you need two businesses. You need a cash flow business, and you also need a capital growth business, which is your property and also potentially your job, what you're doing at the moment. That's going to give you cash flow.
Well, your cash flow business is your job, your profession, your business, your shop, whatever you've got there, which feeds the capital growth business, which is the property side, so that eventually your property business will replace your cash flow business, Brett.
Well, you did
So
talk about
cash flow
this.
keeps you in the game,
Yeah.
but it's actually capital growth that gets you out of the rat race, gets you out of your day job. So it's a stage process. Wealth accumulation through property starts with an education stage, then an accumulation stage, focusing on cash flow, then a transition stage as you slowly lower your loan to value ratios. If you invested well and your properties grow in value, this happens organically because you, as long as you don't keep borrowing, your loan to value ratios drop. And then through various methods, and it depends whether you sell something off, whether you change your assets to cash flow assets, like we said before, maybe shares or ETFs or things like that, or if you're in the right position, can even keep borrowing to live off some equity. But you've got to have a plan to get there, and a plan of what not to do also, Brett.
Yeah, great point. One of the things we often see are people buying in complexes of 300 or house and land packages where there's 5 estates and 5 more planned over the next 10 years. And it's kind of a one-size-fits-all approach, isn't it? But in reality, I guess the people who are very successful in property don't really take that approach, do they?
No. So as we're going through the things the media doesn't tell you, it doesn't tell you that, as you correctly say, one size doesn't fit all. Depends where you are in your journey, what your risk profile is, what your cash flow is. So your strategy should be tailored to your financial your financial situation, your investment goals, your risk tolerance, your time frame, your cash flow. So when we at Metropole put a strategy together, what's the best investment or the right location or the right strategy for one person may not be the right one. Well, isn't the right one for another one. So that's why I believe a customized approach based on your detailed research, but particularly on our clients' personal circumstances, is more important than the market trend of where the next hotspot is, or the fact that Melbourne's going to outperform other areas in the long term. It may not suit everybody.
It's funny you say that, Michael. As we're talking, I can see a list of clients that we're currently searching for. No one has the same budget and no one has the same property in the same
Isn't that
location.
interesting?
So that's a great example of what we're talking about. Number 6, I think people probably 10 or 15 years ago when it was easy to get money, a lot of people kind of thought, oh, the banks are on our side, they're going to give us money. But it's changed, hasn't it? I
The
guess
media doesn't tell you that, do they?
no,
And the
they
banks
don't.
won't tell you that.
They're a business, aren't they, at the end of the day? And the banks want money out of you. And I know a lot of people are finding it hard at the moment. So they're not on your side.
Now, it doesn't mean the banks aren't trustworthy, because they are, but they've got a vested interest. And if they're offering you a particular mortgage, or certain jobs, certain professions, certain industries, some banks are more interested in looking after them than others. The bank won't tell you that the bank with the yellow logo up the road is going to look after you better. So I really believe it's important to see a finance strategist. Now, we know that currently over 70% of all loans are generated by mortgage brokers, not banks, but not all mortgage brokers are the same also. So the idea of having a finance strategy as part of Metropol's big picture strategy of investing is really important. And it's in fact one of the things we start right off with. And we've found that a good finance strategist can often get our clients substantially bigger loans. Not interest rate isn't anywhere near as important as if they can get into a better location.
I guess the other thing, Michael, and we see this in the media, there's so many experts out there, and particularly more and more on social media with all these experts popping up, inverted commas. At the end of the day, no one really knows what's going to happen next. No one knows where the markets are heading, what markets are going to be doing. And we kind of did this exercise. I remember you asked us about 3 or 4 years ago, Michael, you said to us, which market performed the best last year or was going to perform the best next year? It ended up being some place out in the middle of Australia where there was, cows and sheep living there, and all of a sudden there's a housing estate and it's gone up 1,000%. So there's a story in that as well, isn't there?
I'd forgotten that, Brett, but yes, I did remember when we were doing seminars, I actually did some research to see the location that had the highest capital growth in Australia over the previous year. And just because it did doesn't mean it was a good investment location because of the reasons that you said. But that's an anomaly. I guess no one really knows, because all the data, all the analysis can't predict how humans are going to behave. And then every year there's an X factor. A while ago, there was X factors overseas with wars and geopolitical problems. More recently, there were issues overseas with a new president in the United States and tariffs. And currently, there's issues related to elections. So there's always X factors. So don't count on your property to go up year after year, because if you do, you'll be disappointed. All cycles, all property markets, all states have periods of growth, periods of minimal growth, and even for periods when property values go down. And then in the right locations, it all picks up and goes up again and values increase. So how to protect yourself from this sort of information that no one really knows where the markets are heading is, don't be too focused on the short term. Buy investment grade properties, hold for the long term. Make sure you have a cash flow buffer. And a moment ago, we talked about having a finance strategist. Part of our finance strategy at Metropol is to help clients buy time, not just properties, so that when tenants move out or issues happen with the property or other things go wrong, you actually don't get into too much financial challenges because you've got a cash flow buffer up your sleeve. You just got to be able to ride the cycle, Brett.
Yeah, and the next thing to worry about, I guess, with the media is understanding that they're trying to sell fear. Fear sells.
Yes.
You shouldn't buy it. And you can see that at the moment. It's all about those clickbait headlines.
It's a powerful motivator, isn't it? It grabs us.
It is. And look, I think this has held a lot of people back, Michael. I can actually think back to the COVID period and, the doom and gloom. We're going to lose 40% of our house. There was a mortgage cliff. There was this cliff. There was that cliff. We're going to lose all of our jobs. But people kept investing. They put fear aside. They got sick of the headlines. They wanted to get through that. And I can tell you what, those that did invest did exceptionally well, particularly over that first 12 months when others were probably sitting on their hands and waiting for the right sign or waiting for fear to disappear.
It's important to stay informed, Brett, but you've got to be skeptical, especially of the predictions, on one hand, of failure, but also on the other hand of overly optimistic forecasts as well, because it's likely neither of those are going to be right. And look, at the beginning of the year, I'm frequently asked by the media, what are your next hotspots going to be, or where do you think the best markets are going to be? And I don't like giving forecasts because I know that people with all the data are still going to get it wrong, because it really has to do with a whole lot of human behavior. And in general, consumer sentiment, which is driven by what's happening to the economy, what's happening to their jobs, what's happening to interest rates, what's happening to supply and demand, and what they can get for their house if they want to keep moving. So there are too many factors to be able to put into a spreadsheet, Brett.
Yeah, look, I think the other thing to understand as well is these experts in social media and finance media and stuff, they tend to cherry pick data and information to suit their agenda, don't they? So I guess they're never, ever going to tell you the real story or the full length behind that data.
No, the headlines make great headlines, I guess, to grab your attention, especially now that the focus is on shorts. National averages obscure what's happening locally. So one of the very big research houses, and let's be blunt, it's CoreLogic, and we like their data, talk about median dwelling prices. And so therefore Melbourne's median dwelling price is less than a number of other states. But dwellings in Melbourne, a third of them are apartments, while in other states, apartments make up 10 to 15% of the total number of dwellings. So that's why we like Andrew Wilson's data. Dr. Andrew Wilson breaks things down to locations, to areas within a state, and also houses and units. So there isn't one property market in Australia. There's not one Melbourne market. It's based on location. It's based on the type of property, and each state's at its own stage in the cycle. So just be careful when they're giving big picture stories, because you could well miss opportunities because their headlines for that particular location don't sound as exciting.
Yeah, it's interesting. I guess what you're saying there is dig it a little bit deeper, get down to another layer. And the other way to get down to another layer, and something you won't find out sometimes, is I guess those hidden agendas that maybe someone in the media or someone on social media in particular has around what they're actually recommending.
Well, especially in social media. Let's be cautious. I don't think the financial media has an agenda, even though a lot of people will disagree with me. And yes, there are some media outlets there that are pro-shares, others pro-property, others negative. There's always the pessimists out there, and we've spoken about it so regularly, about the unemployment cliff and the mortgage cliff and the financial cliff and the fixed rate cliff. There's always people who are going to scare us. Why are they doing that? Well, the media is doing it because it's not their job to educate you. It's their job. So their hidden agenda is to get you to click on their headlines. But in social media, the agenda is usually to push their services, their developments, certain markets. And so just be careful and question the motives behind the information that you're consuming, and look at multiple sources and look at their track records, Brett.
Yeah, track record and experience, I think, is critically important. Michael, we've covered a lot of information there. Any final thoughts from you?
Well, what we started off saying is let's have a talk about some of the truths and some of the myths that the media is not telling us. So I think we covered those well. And maybe the summary is there's a lot of confusing information out there, and you've got to be willing to seek independent advice. And Brett, that comes at a cost. The most expensive advice, I guess, is free advice that you get from the internet that makes you the wrong decision. All the smart investors I know are prepared to pay for their advice. And yeah, I know if you were to choose the services of our team at Metropole, it does come at a fee. But we don't get people complaining about that. And in fact, in general, they're very keen to our clients know the value of that. They understand that it's their money that's got to work harder. So don't just follow the trends. Don't follow the highlights and the headlines and the hot spots. I think you've got to start with a plan, then do thorough analysis, understand your markets, and knowledge is power. But also one of the things that holds people back is their limiting beliefs or their wrong beliefs. And that's why I have mentors and you have mentors and business coaches as well. You need somebody to tell you to see your blind spots and point you in the right direction.
Well, the bad news is, Michael, you can't buy experience, but you can hire it.
Hey, that's a good point. Well said.
Yeah, so I guess having someone who's been there and done that, and preferably for decades rather than years, is really, really important. Been through multiple cycles and can point all those things out. By the time you've come and learnt all of this, it's going to be one step ahead, and you may have missed an opportunity. I think it's a great time at the moment, Mike. I think there's a window of opportunity to probably do a bit of that. Not necessarily going out and buying today, but certainly getting your ducks in a row, understanding how you're placed, make sure your portfolio is performing properly. If you've got any properties that are maybe come to the end of their life and we need to maybe replace them, and think of it more strategically and get you back on track. I think it's an ideal time to do that.
Well, sometimes the right thing to do is nothing. If you're not in the right position, or if you don't have enough money to buy what I'd call an investment grade property, then the right thing is don't do anything until you are in the right position and only own investment grade properties. So, Brett, thanks again. It was a fun chat. Look forward to catching up with you again next week.
Likewise. Thanks, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
This mindset message, I want to ask you, are you going to be prepared for your moment? Let me explain what I'm on about. Winston Churchill was quoted as saying, to each there comes in their lifetime a special moment when they're figuratively tapped on the shoulder and offered a chance to do something very special. What a tragedy if that moment finds them unprepared. Well, that was Winston Churchill's quote, and I sort of agree with it. It's a reminder of the brief windows of opportunity that life presents and the importance of being ready. You see, life is filled with uncertainty, and our natural instinct is to plan in order to avoid challenges and uncertainty. But planning is based on the expectation of order, of things happening in a particular way, but life doesn't usually work that way. On the other hand, preparedness is based on the expectation of chaos. Preparedness is how you thrive through uncertainty. The problem is, as humans, our instincts drive us to seek order and predictability. Look, we plan our careers, our finances, our personal lives, our investment, with the expectation if we follow certain steps, certain outcomes will follow. However, I've found that progress through life is rarely linear. It twists, it turns, it presents unexpected challenges, and no plan can predict that perfectly. Anyway, this unpredictable nature of life doesn't just invite chaos, I guess it guarantees it. So let's look at it this way. You're probably standing right now, looking out there, seeing what's ahead, and life's going to walk up and tap you on the shoulder one day, according to Winston Churchill. And you don't know when it's going to happen. You don't know what it's going to look like. You don't know where the journey is going to take you. But that moment's your moment. If it passes, it'll never come again. Are you going to be prepared for it? What actions can you take today to make sure you are prepared? Now, I believe preparing means developing a broad set of skills and mental resilience that can be adapted to variable situations and lots of situations. It's about being ready to pivot and adapt when life inevitably throws a curveball your way too. Preparedness is not about predicting the future, but being ready to face it, whatever it may hold. So Churchill's quote is a reminder that this tap on the shoulder that comes once in a lifetime, it may be a surprise to you. It comes once in a lifetime, and it could be a career move, an unexpected investment opportunity, a personal revelation. But these are the moments that define us. So I should be recommending to you, ask yourself, what can you do today to prepare for tomorrow's uncertainty? Can you take a course to improve your skills? Can you learn and educate yourself more? Can you start a side project that may grow into something big, another business? Is there a network you can join or build that's going to open up new opportunities? Every step you take in preparedness today could be the deciding factor in seizing your moment when it comes. So my mindset message for you today is that Churchill's warning about the tragedy of being unprepared should be a call to action to you. It urges us not only to plan for what we expect, but also to be prepared for what we can't foresee. Life's most significant opportunities are often disguised as insurmountable challenges, and only those who are ready will be able to transform these challenges into victories. That tap on the shoulder may come at an unexpected hour. So, will you be ready to answer the call? Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favorite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?